talking about life insurance and how it can serve many purposes. Now, I will caveat this with, I'm a licensed insurance salesman and I don't even sell insurance to myself. I am not an expert. I brought Luke on to advise me on selling insurance to myself, even though I'm licensed for that. So that's how confident I am in him and in my future with him. So without further ado, I'm going to have Luke just basically take it over and talk about the variety of ways that we can use insurance to either use it as a different asset class, to use it as a wealth transfer mechanism, to use it as insurance, right? So take it away, Luke.
Well, thank you, Stuart. I really appreciate the warm introduction and the kind words, and it's been a pleasure working with you as well. All right, so let's dive right in. So as Stuart mentioned, Vantage Insurance Solutions, we do take that approach of education. We don't want to be that guy that sold you the policy. We really seek to come alongside our clients and partner with them to provide education and guidance. Listen, we don't have an axe to grind or a dog in the fight. I really don't care what policy you buy so much as I care that you buy the right policy that's designed the right way to suit your purposes and goals. And the goal today, to me, and I know in Stuart's introduction, is to provide you with a little bit of data that you can take action with, then help you be a smarter buyer of insurance products, see where it might fit in your overall financial plan. And so we're going to go through some of the most important topics that seem to come up often and answer some of the most common questions, hopefully, and then we can go from there. So let's jump right in and talk life insurance. First and foremost, we're going to talk about what are the different kinds out there. There seems to be just a myriad of products and choices, and they're marketed to us a slew of different ways. And it can be tough to cut through all of the smoke and mirrors as to what the real comparisons are and what these products actually do. So we're going to try and simplify it a little bit for you today. So there's two main categories, as you can see here on the screen. There's term insurance and there's permanent life insurance. And virtually all policies out there in the marketplace fall in one of these two categories. And so we're going to break them down a little deeper as the different types of term products, permanent products, and why you might choose one over another. And then I'll tell you a little bit of insight as to where my clients typically fall in real life. So first of all, term insurance. Pretty straightforward stuff. Term life insurance, as I'm sure most of you know, so I won't belabor it too much, is a fixed death benefit with a fixed premium for a fixed time, and it's pure protection and typically the least initial cost. It's pretty straightforward. You trade premium dollars for protection dollars, and it doesn't do anything for you unless something bad happens. That's kind of like your auto insurance or your homeowner's insurance, these things that you buy that you want to protect yourself or your family or your business for a temporary period of time for a certain purpose. And it can be designed, as you can see here, what's called an ART, an annual renewable term. So that's actually one of the most common forms that are sold via mail and a lot of these online advertisements. A lot of times these companies will lure you in with these really cheap initial premiums. It's because they renew each year or every 3 years, and that price keeps creeping up on you. And overall, the cost can be far greater than locking in for, say, a 5 or 20 or 30-year term for time frame and what is typically sold. So you got to really be careful and know what you're buying and how long those guarantees are going to last. Because those are one of the things where people get blindsided. 5-10 years down the road, they look at their bill and they go, how in the world did it get so high? And that's one of the reasons why. So you got to be careful with that stuff. But they're typically anywhere from annual renewable all the way up to 30 years, sometimes to a specific age, like age 65 or age 100. They don't typically go to age 100. I've seen a few rare products that are sold in more of the group market space. Usually the oldest term insurance will go to is about 80 or 85.
Yeah, I got to think 100's got to be pretty expensive. What do you normally see, Luke, as far as a average length of your term insurance?
Yeah, most people buy 20 or 30-year term. They're thinking, hey, till my kids are grown and gone, or till my mortgage is paid off. Those are kind of the benchmarks people have in their mind. In business, there's typically term insurance that's bought in business because they're figuring, hey, I'm going to retire in 10 years and I want to make sure I'm covered until I retire to cover the buy sell or the key man life insurance exposure.
Yeah.
Or there's a business loan, and that business, the bank is requiring that loan is collateralized by a life insurance policy. So if a key person in the company dies, they have assurance that that debt's going to be paid. And so they buy that insurance for the exact length of time that the loan is designed to be paid off.
That makes sense.
And then a rare one, decreasing term. Sometimes people buy mortgage insurance where it's life insurance designed to, basically run alongside your mortgage. Doesn't make a lot of sense. It's just getting an honorable mention here because it's out there and it's being sold, but it's usually a bad value. By and large, in the comparisons I've run, it costs every bit as much or more than a typical, say, 30-year term policy. But a typical 30-year term policy may have all the benefits of convertibility, terminal, protection, terminal illness protection, and full value the entire time, as opposed to decreasing term where the coverage is decreasing over the length of the mortgage to follow the mortgage principal balance. Usually doesn't make a lot of sense. It's just kind of a gimmick and something that people cross sell to make a little side money, and it's better than nothing, but that's about all it's better than typically.
Yep.
So let's talk now about permanent insurance. So in the permanent insurance category, there's a few different types of products primarily. The first one, we're going to kind of move from the most guarantees and the most certainties all the way down to the most flexible and also the most variability and risk. So first one is whole life. This is a term that many times people throw out there to refer to permanent insurance in general, but it is actually a type of permanent insurance. Whole life, like the name suggests, tend to be designed to last your whole life. And it's meant to be an actual asset, as opposed to term insurance it's a liability unless something happens. Whole life insurance is designed to be an asset. Either you'll live to maturity date, in which the company will literally write the death benefit check, even though you're still alive, and pay you out, or you'll pass away and they'll pay it out that way. It also builds what's called cash values, you can see here, that are 100% liquid all along the way, that are very usable, and depending on how the policy is designed, can grow pretty aggressively. It all depends on how the policy is designed as far as that factor goes. And the money that grows inside it as cash value is tax-free and typically can be accessed tax-free, much like a Roth IRA would be accessible tax-free. And so it's very flexible. And it also gives you guaranteed access to the insurance company's money with no questions asked up to the value of yours. And that's something we'll talk a little bit more about later. But whole life, the key characteristics of it, as opposed to some of the other permanent insurance products out there, is all the guarantees. The cost of insurance is fixed and guaranteed over your lifetime and level. And the premiums are the same. And the base cash value crediting and interest is guaranteed. And up till about last year, the minimum guarantee was 4%. Now it's 2% because of the low interest rate environment we're in. But interestingly enough, most carriers are maintaining a much higher interest crediting rate, even though the minimum required by law is only 2, due to the 7702 IRS code law that got adjusted because of the low interest rate environment. Whole life tends to be one of the best tools for using as a cash flow management strategy, as well as this asset class approach and things like that, because there's so many guarantees, cutting out any risk of undermining the policy. It tends to be really stable and very useful for that. The next one here, IUL, or Indexed Universal Life, has a little more moving parts, has more ways to do it wrong, but can also be a really great solution for a safer asset class like you're talking about, Stuart. But this is tied to an index. So unlike the whole life, where the interest and the dividends credited with what's called a participating policy, which is a policy with a mutual company, where the policyholders literally are the owners of the company, which is why they get the dividends. In a universal life policy, it's tied to an index like the S&P or the Dow or whatever it might be. And so your earnings and creditings to your policy are reflected by that index performance. And there's different indexing strategies. We're not going to get into the weeds on the indexing strategies, and the different index accounts there are out there. But the bottom line is, if the index does 10, you would get, depending on the design platform you chose, that full 10 or some percentage of it. So many of the reasons people like this is you have a way to sort of cut off any loss potential while having nothing but upside potential. So it might have a 0% floor or a 1% floor, or even a 2% floor, like some of the ones that I work with, where if the stock market does negative 20, you're still going to get at least a 1 or 2% crediting regardless. And that's the beauty of using the IUL. Now, it's because the premiums are more flexible and it's based on an ART platform, these really need to be overfunded. You don't want to pay the base minimum premium on these types of policies. And that's where these have gotten a bit of a bad reputation and have been really just honestly misused and missold. Because some people bought these because of the lower initial premium, and it's still a permanent product. However, the premiums increase over time internally. The premiums are flexible and based on market conditions and the carrier's experiences and cost and their investment portfolio experiences, they're going to adjust that cost of insurance, and it's definitely going to go up over time. If you pay just the bare minimum, eventually that cash value is going to start to get eaten up to offset the costs, and ultimately your policy will lapse and implode because it's not out earning its costs. But if you fund it properly and design it properly, it's not that difficult for it to far outpace its costs, and that changing cost internally isn't a problem. But it takes more management, and you got to pay attention. And that's the kind of the key caveat with universal life. And then the last one, variable universal life. I'm not going to get a lot into this one, but this one actually invests directly in the market. This is one where you actually have a separate account. Your funds are exposed to market gains and losses. And there's tends to be a lot of fees tied to it. There is a place for a variable universal life. I pretty much never sell it, quite frankly, because my goal is to be your safe money source.
Yeah.
Very complementary to what you do, Stuart. Either it's about protecting your wealth and your lifestyle, or it's about being a more predictable wealth growth. So variable universal life just doesn't really fit in my realm very well. The really one situation that I've seen people use variable universal life where it can fit is when someone has exhausted all their other tax favorable investment sources and they still want full market exposure, but they want a tax favorable place to put it. They'll choose a variable universal life and they'll overfund it to the max and keep it in a more tax favorable place. But that's kind of the one situation where it might be a good fit.
I have a quick question. So if you overfund, can you have a cash value that's higher than your death benefit?
The simple answer is no. No, typically never, because when you design it the right way, pretty much no matter how you slice it, that death benefit will always grow as the cash value grows. And it'll be either adding to the cash value, usually about dollar for dollar, or it's doing what's called buying paid up additions, where the cash value actually buys more death benefit. As it grows, it also grows the death benefit, many times outpaces it. And so, for example, you might have 100 grand in cash value, but that 100 grand is actually adding maybe 150 or 175,000 to your death benefit. And so as over time, they just kind of keep, sliding on the same scale.
I was thinking about this as being like a flat death benefit, but that makes sense now. So it just continues to rise. Okay.
Yeah, there is a way to design the universal life and the variable universal life to where it has a level death benefit, but it also kind of tends to hinder the cash growth and it hinders the funding, because you have to stay with, if you want to keep it tax-free, you have to stay within certain ratios, and you start coming up with different design problems to keep it tax-free if the death benefit doesn't continue to grow, which we can get way in the weeds on, but
yeah,
by and large, pretty much always design it to where they grow together. That way, if you pass away, your beneficiary tends to always get the full death benefit value plus even an even greater value of what is representative of the cash.
It's awesome being worth more dead than alive.
There you go. Right. Right. So some of the key features, we've already talked about this, of death benefits, but just to be clear, I've had some people ask me, are death benefits ever taxable? If it's done right, no. The answer is no. Death benefits are pretty much always tax-free. There's rare scenarios in business context where I've seen people try and deduct all their premiums from their taxes, and they get into a sticky situation where now, because they've deducted their premiums, that death benefit loses its tax-free status, or the cash value loses its tax-free status, or both. So as long as you're not trying to play tricky games with taxes, it pretty much always goes tax-free to the beneficiaries. And you want to work with your estate planner as well to make sure trusts and things like that are set up properly, so money gets to the ultimate end user in the most tax advantageous way possible. But that's one of the reasons life insurance can be so great for wealth transfer, not just income protection. And this is one of those other elements where is often missed in wealth planning. And the question people ask, well, why would you ever need life insurance beyond retirement? Kids are grown and gone, mortgage is paid, theoretically. Some of these things all tend to line up. You don't need protection anymore. Well, the other element of it is wealth transfer, inheritance, charity, estate tax, and various other things. And it's one of the most efficient ways to get wealth to the next generation. So it can be, and that, which is why a lot of people want at least a certain amount of permanent insurance. It's always going to be there till the day you die to facilitate some of those goals. And so it can be used for anything. That's the other kind of nice thing to know. There is no strings attached. Same thing with some of these living benefits, as you can see in number 4. Once you get the payment, you don't have to use it for the mortgage. You don't have to use it for funeral expenses or whatever. You can use it for whatever you want. The only caveat to that, as you can see, is collateral assignment. And that's when, like I mentioned in the business context, the bank is making you take out a life policy in order to secure your loan. You have to collaterally assign a portion or all of that death benefit to the bank if you die. That's the one situation where there's strings attached to the death benefit, so to speak. The living benefits can also be extremely helpful part of planning and kind of cover more bases and multitask your dollars. There's typically a maximum of 4 living benefits: critical injury, critical illness, chronic illness, and terminal illness. Those are all just ways to accelerate the death benefit, as it's called. So if you have a $1 million death benefit, these living benefits will allow you to access anywhere from 50 to 75% of the death benefit for these conditions. You have a major heart attack and you have a critical illness rider, you can access up to 50% of your death benefit to help pay for medical expenses or whatever you want to pay for. Terminal illness, you have less than 12 months to live, you submit that claim to the carrier and they'll let you access your death benefit while you're still living. So there's a lot of ways to help protect you as the insured. You don't have to die necessarily to access that death benefit, in other words. So there's some other nice fringe benefits. Many of policies these days include some of these at no cost. Okay. So it can be a great thing to build into the plan. We talked about some of these, so I'm not going to hit on it in the conversation. Income replacement, what do you use it for? There's a host of things, but at the end of the day, whatever you want. Let's go back to another common question that's asked is, well, how much do I need then? How much life insurance should I buy? I want to clarify that question a little bit better. Rather than asking how much do I need, the real question is how much do you want? Because really, what are you trying to accomplish is the question. And that goes back to Stuart's point in the very beginning, is we want to help guide you into asking the right questions. People tend to buy just round numbers because they sound good, but that's typically inefficient or putting you in a position of risk that's completely unnecessary. And so tying it to clear financial objectives, either for on the asset side or on the protection side, makes way more sense. Because here's the reality is, wealthy people buy life insurance all day long in the billions. People who don't need life insurance buy boatloads of it, but for a certain financial purpose. And so that's really the question you want to ask is, well, what do you want to accomplish? And what are your goals and what do you need these things to do that life insurance may be particularly suited for? It's just a financial tool. And so in asking that question, this is how I typically will take my clients through the thought processes. What do you want it to accomplish? So on the personal side, on the top chart, you would say, okay, was there debt you want paid off, the mortgage, things like that you want to make sure, cars maybe, so that your family gets those things. Income replacement. This goes back, Stuart, to the kids, we have maybe 10 more years till college. Okay, well, want to replace my income until then maybe my wife's going back to work or my husband's going back to work or things are going to shift. How much and how long? And we multiply that out. Final expenses, if you're someone who wants, a burial plot and a casket and the whole 9 yards, and that can add up to 20 or 30,000, might make sense to go ahead and add that to the equation. And then other financial goals, whether it's college for the kids or again, charities or inheritance or other things that you want to make sure happen no matter what, we build that in as well. And then we can kind of come up with a good number that's tied to real financial goals. You're going, okay, this is that number. This is what you need this to accomplish for you. And then we kind of work backwards from there based on budget, benefit, and other financial things. And we find the balance between those competing objectives. But this gives us real clarity as to what exactly it's accomplishing and why. On the business side, you'll see I use a bit of slightly different calculator because we might be talking about buy-sell agreements and buying out an owner's shares if they pass away to pay off their spouse and their family, or it might be key man. So we're replacing lost revenue with what that employee was accomplishing, hiring expenses, other goals like exit strategies and retirement planning, kind of calculate a variety of other financial objectives for business owners depending on what they're trying to accomplish. But then we can, again, tie it to a real number.
Can you help me understand thinking of a scenario, I'm actually thinking of a common client that we have that we went through this kind of calculus and he needed X number of dollars insurance. This wasn't the number, but let's say he needs $5 million of insurance. How do you determine what's the best mix between whole and term? Is it just the affordability, or is there something else? Like, I know one of my clients couldn't really afford any whole at all. And so it was 100% term with a potential convertible to whole life. And that's great. But what about somebody who can afford it? Is it, if he can afford it, should it always be 100% whole? Or what are your thoughts on the?
So there's a mixture of things we're going to be taking into account. For one, you kind of looking at the overall financial picture, we're looking at cash flow. So definitely it's a budget question. We're looking at, sufficient allocation to their retirement investments that you would be managing and these other things. Is there enough to go around, so to speak? In a perfect world, if you could put it all of your protection into also an asset, all of it in whole or all of it in IUL or some blend of the two, depending on risk and other objectives, that probably would, in a perfect world, be the best scenario, because ultimately you're buying an asset. However, rarely the case. And so usually we're managing a budget and we're going, okay, I need 5 million in protection, but I've got a budget of X amount to allocate for safe money, asset type class, as well as protection and things like that. And how do we blend it so that if I die next month, my family gets what they need? But if I live like I expect, I'm putting as much of this money as possible to good use, no matter what the outcome is. And that's where I'll find that blend. Okay, all right, well, maybe we're going to do 3 million in term to get you through to retirement. And we're going to do 2 million in some form of permanent insurance. And we're going to look to have that be your storehouse for emergency funds and financing and different things, and be that sort of safe money asset class. But it'll primarily be driven by cash flow and budget to find that balance. Cash value features. So again, just going to touch on some of this stuff. We kind of stole our own thunder a little bit in some of our conversations, but average rates of return, we're going to look at some actual charts and historical returns here in a sec. But typically over the long term, you see that these policies very comfortably perform at about 4 to 6% in a tax favorable environment, liquid all along the way. What is their use? What role do they play? Here's the other thing is I've pretty much never positioned it as a return of premium type of proposition. Like, hey, in 20, 30 years, you can just kind of pull all your cash out and run. Well, yeah, that's an option. You can always pull all your cash out and run. But a well-built financial plan typically involves a couple extra buckets of money that need to be safe and liquid, like your emergency funds and short-term savings and things. We're going to talk a little bit about that. And that money really isn't suitable to be put into a high-risk environment in the stock market or in real estate where it's not liquid. And so you need it to be productive. And most people put it in the bank or under their mattress, and it's they have a significant lost opportunity cost. And so that cash flow can now have a more productive place to sit in between uses because it's liquid and it gives you access to the insurance company's money. So that cash value can play a really good role in your financial life.
I'm going to stop you there for a second, because there's a thought process that I come across a lot, where people want to pay off their mortgage early. And I've always said, if you pay off your mortgage early, let's say you have a 2.5% loan or 3% loan, pick a number, 3% right now is kind of very typical number. If you're paying off that mortgage, you're guaranteeing and locking in that 3% rate of return for the length and the duration of that mortgage. So maybe it's 20 more years. So you've said, if I'm okay with getting 3% on my money for the next 20 years, then you should go ahead and pay that loan off. And what I also point out is, if you pay that loan off and then at some point down the road, you need it, or let's say you skip a payment and you just are going into hardship, you don't get to go to the bank and say, hey, I paid all this extra money. Can I skip this one payment? They're going to tell you no. And they may not even allow you to access the equity that you have built up in your account over time for your mortgage. Potential better way is put the money to work in something like this that's paying, you have an arbitrage there. If it's paying 4 to 6% on average over a long period of time, and you're only paying 3, you get that arbitrage and you get to access the money at your discretion.
Right. Great advice. Something that I encourage my clients in. The key principles when it comes to the strategies that I employ personally, and I encourage my clients to employ, is what puts you in the position of greatest control. Are you putting yourself at the mercy of the bank, Or are you putting yourself in a position where you get to choose when and if to access your money and your assets? And that's one of the roles where this can play when done right.
Yeah.
It's the reason why Bank of America has $23 billion in life insurance. Chase and Wells Fargo, more than they own in real estate even. It's liquidity and control. Profit and cash flow and other things actually come secondary to the liquidity and control. And this idea of perpetual wealth financing is really to mimic what banks and institutions do by managing these two buckets of money: emergency funds and short-term savings. Money that where the vast majority of our wealth tends to go. This is a place that you can house some of that money and put it to good use along the way and multitask your dollars. And there's these two typical characteristics that you want for these two buckets of money. You want them safe and liquid. An emergency happens, you need to get to it. You want to save for the vacation next year, you need to be able to get to it. And it needs to be predictable. You can't have it lose half its value along the way because you put in some volatile investment. But there's two more caveats or two more characteristics I like to add to these buckets. This money should not only be safe and liquid, it should be productive, and it should be tax-free if it can be. If you're going to build a predictable volatility buffer of an asset, you want to insulate it both from taxes and you want it to outpace inflation ideally.
4 horsemen of
investments,
of assets and investments.
There you go. Safe, liquid, productive, tax-free. That's my goal when we design these plans, is to fulfill each of these check boxes. And so I'm going to talk about what that looks like in a practical sense, because really it's just about buying things and moving money in a profitable way. There's 2 ways to do that: the cash and credit, right? You either use the bank's money at a cost because you don't have enough of it of your own or you want to leverage it, or you pay your own cash. But both are financing. They both have payments. They both have interest costs. Now we know how the debt side works, right? You take your loan out, you're in the negative, you make your payments, you work your way back to zero. The interest tends to be a bit front loaded, especially on mortgages and car loans. But you're at the bank's mercy. Like you mentioned before, you miss your car payments, they take your car. You miss your house payments, they take your house. They set the terms and they have the charges. So we know where the interest costs are. We know what the payments are on that side. On the cash side, it's the opposite. You don't go out and buy the car today or the house today. You first start out making payments to yourself, building up your accounts and your cash. And then you go out and you buy that thing and down goes your money. And if you want to have the freedom of choice and control in the future, you have to immediately begin paying yourself back, right? And for the many Americans, sadly, they don't have the discipline or the wherewithal to pay themselves back. And so they end up perpetually below the line instead of above the line, right? And that's why the average American loses 34% of their life's earnings to finance costs, is because they're at the mercy of the bank and their resources. But if you have the discipline to pay yourself back, you get to operate above the line and keep more of your money, but more importantly, stay in control. But there's a cost to that. If your money is productive, then spending it has a cost. It's called lost opportunity cost. That's what economists call it. And what that looks like is this. So you have 50 grand, you pull out 30, you're now only earning interest on 20, right? Well, what would 30 grand have done over 30 years for, say, someone my age? Well, 30 over 30 years at 4%. Turns into $100,000. You lost $70,000 in lost earnings when you spent the 30. So 30 grand isn't just 30 grand. A dollar today isn't just a dollar today. And you know this, of course, Stuart. I'm sure this is something you teach to your clients all the time. This idea of lost opportunity cost. Spending your money has a cost to it if it's in a productive place. And this is where maybe accessing this arbitrage idea that you talked about really comes in handy, because one of the unique things about a properly designed life insurance contract is that you have guaranteed access to the insurance company's money up to the value of yours. And this idea of perpetual wealth financing is to build a perpetually growing or compounding asset that also performs a financing function of your life or your business. And so in that situation, you employ that, you build up your wealth in the same way you would in your bank account. But when you go to borrow the 30, you're still earning compounded interest at the full 50, not the 20. Your money continues to grow unhindered. And then just like you'd pay the bank back, or just like you'd refill your savings, you pay your policy back, but you never lose that compounded growth at the same time. And you have all the control and flexibility and choice of spending your own money, but all of the benefits of using other people's money at our OPM, other people's money. Yeah. So that's just a high level idea and version of how some of these strategies work and why the affluent and the wealthy tend to use life insurance more as a wealth tool than just a protection tool.
Yeah.
I'm going to give you a couple quick facts and figures on performance. Here's one of the top carriers I use. I have access to virtually any carrier in the marketplace, but I have a handful I keep close because they're among the best consistently. This is one of them, and they're kind of giving their historical chart they recently came out with last year, showing what their IUL did and what it illustrated versus what it performed. And so you can see the illustrated was 8.14, the actual credits was 8.45, and you can see the index performance 5.79 versus 5.74. And so it kind of gives you a track record here. We can track many of these carriers and policies back literally to the 1800s. These carriers have been around. Penn Mutual, for example, have been around since 1842. Emeritus, 1870s. One America, 1880s. A lot of these companies, New York Life, been around. Some of them longer than the IRS has been around. And so we know the stability of their dividends and their track record. It's a lot less guesswork than some people think. Looking also as well at some of the index crediting rates, we can kind of see the credits versus actual versus illustrated. Just again, showing that a lot of these companies, they tend to illustrate things conservatively. They tend to be cautious. Insurance companies by nature are risk adverse in ways, and they're meant to build safe money. And so they kind of project, and then we take a look back, and sometimes they outperform what they even projected. But I always work with carriers who would rather underpromise and overdeliver. That's one of the things that I look at when I look at a company I'll work with. I don't want the one that just has the flashy, high rates that they're quoting you. I want one that can show that they've proven to deliver over time. Some sample dividend rates over time as well, just to give you a flavor of the whole life dividend rates. You can see ranging in the 4s, 5s, and 6s, some of them even over 7 in their published dividend rates. Now, the caveat here is this is the gross dividend rate before insurance charges, things like that. This is the net or the gross cash value dividend rate. So if you want the net dividend rate and the actual cash performance, that's where I come in. Because when I run these illustrations, these different carriers, they calculate their costs and apply their cost of insurance and fees and things differently. And so as a consumer, looking at these numbers is somewhat meaningless, quite frankly, because comparing them can be very challenging because of how they manage their money, how they design their policies and their structures can be very different. And so that's where when I run illustrations, I can run comparative analysis on actual dollars and their performance, their net internal rates of return after all costs and before costs, and we can isolate those numbers to compare them accurately. But at the end of the day, net, we know that historically, even the whole life ones here, where they're not participating in the market, tend to perform at around 4 to 6%. All things said and done over time. So,
all right, so I got 2 questions for you. So I see the Mass Mutual numbers are significantly higher than most.
let me go back.
Are you
Yes.
suggesting they have higher transaction costs or fees, or what enabled them to get the higher rate of returns?
So there's a few factors. One is how they assign dividends and how they deal with loans. You have 2 different types of carriers. You have a direct recognition carrier and an indirect recognition carrier. A direct recognition carrier like Mass Mutual and Penn and Guardian has some mixed. What they do is when anytime someone takes a policy loan, that policy loan affects the cash earnings and reduces the dividend crediting rate a little bit on the collateralized money. Still gets credited at typically about the same rate, but it'll get reduced. And therefore, they tend to have higher dividend rates like Mass Mutual. You see the 7s and these higher rates, but they also will cost you more when you take policy loans. And there's a sort of a trade-off for that. The indirect recognition carriers tend to have lower dividend rates, but when you take a policy loan, there's 0 effect on any of your cash value. But overall, their dividend crediting rate is less. So it's all kind of a wash across the portfolio. So that's one factor that affects these sort of gross rates that they publish. But then the other factor that really is hard to put your finger on, unless you run actual illustrations, is how they design their cost of coverage based on your age and rating class and all that. So for instance, Mass Mutual, yes, their net dividend rate or the gross dividend rate might be 7%. But when we run an illustration on a 52-year-old who is maybe a standard non-tobacco, When it's all said and done, the net rate might be more like 3.5 or 4. So that 7, it can be somewhat misleading until you run an illustration based on someone's unique age and rating class to figure out what the net crediting number is.
There's a question from the audience is, do these dividends reduce your tax or your death benefit?
No, the dividends don't reduce the death benefit. Dividends are payments from the insurance company based on their loss experience and based on their profit and experience of their investments. They share their dividends and profits with their policyholders, and adds to the cash value, and typically in turn adds to the death benefit. So it doesn't take from, it adds to. So some common myths. Let's talk about some common misunderstandings. We've already talked about some of these. If you don't need life insurance, you don't buy it. We know the answer to that. We've talked about it. Listen, life insurance is nothing more than a financial tool. It can be designed a myriad of ways. There's a myriad of products from a myriad of carriers. And you may not need it, but you sure might want it because it fulfills a vital role. Listen, if I can hammer a nail with a crescent wrench, I might not need a hammer because I got a crescent wrench, but it turns out a hammer is a whole lot better for driving nails. And if I could have one, I'd sure like one. Yeah. That's kind of the idea here. It's like, it doesn't really matter whether you need it at the end of the day. What is it? What do you want to do? And making the most use of your money. Term insurance is the cheapest. Well, the real answer to that is, well, it depends on how you calculate cost. If I can design a permanent policy that out earns all of its costs pretty quickly, as in less than 5 years, well, then the term insurance is by far more expensive because every dollar is an expense. And ultimately, a permanent one could be more profitable. However, if we're talking about cash flow, well, then, yeah, term insurance requires by far the least amount of cash flow. As I mentioned in the beginning, I tell you where most of my clients fell. Most of my clients have a blend. Most of my clients have some permanent and some term because of these different competing objectives of needing enough protection right now, but also having certain asset accumulation goals and being able to house a certain amount of cash flow for these different objectives. Life insurance is an investment. Well, it's really an asset class. Like we talked about, Stuart, it's an asset, and it can be designed a variety of ways. One type is best. You get a lot of insurance salesmen. Again, this is how you can spot a salesman. They have a pet product. It might be term, it might be IUL, it might be whole life, but they say this is the best product for everybody.
Might be whatever's paying them the most at the moment.
Maybe that could be possibly something to do with it as well. But anytime you hear someone say this is the best product for everybody, that should be immediate signal to exit, because there is no one best product. These are, again, financial tools that are suited for different purposes and different people in different seasons of life with different goals. And so the real answer to that is, well, there is no one best policy. It's all about fitting the right design for the goal and purpose. And what makes sense for you may not make sense for someone else. So that, at the end of the day, is designing the right thing. A couple other final worthy mentions, and we'll get into if there's any additional Q&A. Some other nice benefits of securing a policy for, say, yourself at a young age or for your children. Like I have policies on my children. And one of the reasons is this first additional benefit is guaranteed insurability. One of the nice things about it, life insurance, is it's a unilateral contract. What that means is, as long as I pay the premium, the insurance company has all of the requirements that they have to fulfill. I'm in control. As long as I pay the premium, they have to provide all the benefits. They can't change them or revoke them for any reason whatsoever. And so, yeah, one of those things is guaranteed insurability. If I have a policy, that I'm guaranteed to maintain my insurability. And sometimes you can add a rider that allows you to buy more coverage in the future with zero proof of health or anything. You could be terminally ill and decide to exercise that right and buy more coverage. And they'll issue it at the rating class you originally were approved at. So there's some great ways to protect your future self from losing the ability to take advantage of this financial tool by protecting your insurability early on, or your children, which is why many people will buy it for their children or their grandchildren to help set them up for the future. Some other nice things, ability to add to and grow with them. Many of these policies, like I said, do have this growing death benefit. And so as you add to your family, and as your needs and expenses grow, or as your goals for retirement grow, the policy can grow and be flexible to grow with you. Transferable. So for children in particular, like for example, I own my policies on my children, but when they get older, I can transfer ownership to them and they can take it and do whatever they want with it for the rest of their life. In the business context, there's ways for business entities to transfer a policy to an owner, say, when he exits and retires out of the company. Now he can take that asset with him as part of his retirement strategy. And it could be a valuable way to build towards that or to build towards a buyout. So there's some great uses there. They can be paid up. Another thing that a lot of people don't realize is you don't have to pay for these things forever. A permanent plan doesn't mean you have to pay permanently. They can be paid up in a 10-year period, a 20-year period, or really just about any particular time. You can choose a payoff time where you go, I'm going to stop funding it at this age, and then it'll either self-fund or it does what's called a reduced paid up, where they drop the death benefit down a little bit to whatever you've effectively paid for, but then it's locked in and the cash continues to grow and you have access to it the rest of your life. And then, like I mentioned,
right?
What's that?
You can even do a single pay.
You can. You can. I've had clients who are looking to transfer a little chunk of money, and they go, "Hey, I've got this, $100,000 that isn't for me. I have no intention or need for it, other than to pass to my heirs." And they dump it into a policy, and it's tax free, and it goes to their heirs whenever the time comes. And so it can be done that way as well. Hopefully, we've given you some good, actionable information that helps you feel a lot better informed as to how this fits in your wealth plan. So
that's fantastic, and appreciate it. For anybody who wants to get a hold of Luke, obviously the information's there. You can get a hold of Luke through me as well. We can be reached at stewart@cruiseassetmanagement.com. I have a question that kind of relates to a topic that we had earlier. It didn't seem to fit into the flow of the conversation, but it said, if you remember about that moving death benefit that was kind of increasing, it said, if you have an existing policy, can you change it to a sliding or moving death benefit? And do they always move and increase, or do you have to adjust the policy so that they do, or how does that work?
And that's a great question. You can change it. Actually, many times with the IUL design in particular, the indexed universal life, we'll have it be an increasing death benefit all the way up to retirement or whenever they plan to stop funding it. And then the moment they plan to stop funding it, we lock in the death benefit so it's no longer increasing. That way we can kind of cut off any changes in cost in the future and reduce expenses and maximize growth. So you can actually change it in the future for that particular type of policy. Whole life is more like locked in. You can't really go in and out of that design. Once you set it up, it goes as designed. But IUL, you can actually kind of go back and forth and you can lock it in later. You can even decrease it. Let's say you have $1 million policy that's growing all the way up to retirement. You go, and once you get to retirement, you go, you know what? I want this more for cash value than I do for death benefit. I want to go ahead and knock that death benefit down to $500,000, and basically all the way down as far as I can without triggering the modified endowment contract rule, which makes it all taxable, and then just emphasize cash growth and cash usage. So you can even reduce it down below intentionally if you wanted to. And you can design it from the initial onset either way. You can design it to stay level, or you can design it to increase. There's reasons for both. Most of the time it makes sense to have it increase and then lock it in later. But yeah, hopefully that answers the question.
Excellent. Well, I appreciate it. I don't see any more questions from our attendees, so I think that was super informative. I actually even learned a little bit more about insurance myself, so that was fantastic. Without further ado, again, Luke, I appreciate your time and your expertise.
My pleasure.
Thank you for everybody attending. This is Stuart Cruz from Cruz Asset Management signing out. And don't forget to invest with the odds in your favor.